Canada's richest secret costs 83% of you $1.2 million. You asked for the #1 investing strategy. But before I answer, you need to see the battlefield. Because in 2026, Canada's investment landscape isn't just changing, it's fighting for survival. Business investment in Canada has dropped for 7 straight years. 7. Not a typo. That's $42 billion that should have built factories, hired workers, grown your future returns. Instead, it vanished. But here's where it gets worse. Inflation isn't just high, it's sticky. The Bank of Canada's own data shows inflation hasn't dipped below 3.5% in 18 months. And that's the official number. What does that mean for you? If your portfolio grew 7% last year, but inflation ate 5.2%, you didn't gain 7%. You gained 1.8%. And if you're not diversified, you're not just losing money. You're losing time. Time to retire. Time to build wealth. Time to protect what you've earned. But here's the question no one's asking: how does this affect your portfolio? Stick with me. Because the answer isn't what you think. You asked how this affects your portfolio. Let's start with the truth no broker wants you to hear: most actively managed funds fail. But here's the kicker: index funds don't just win, they dominate. In 2025, the Vanguard Fhsa Canada All-Cap ETF returned 11.3% annually over 5 years. That's not luck. That's math. Now, you might be thinking, Lydon, I've heard this before. But have you heard this? The average Canadian mutual fund charges 2.1% in fees. That's not a fee. That's a wealth tax. Therefore, if you're paying more than 0.2% for an index fund, you're getting robbed. But here's where things get interesting. Canada's tax-advantaged accounts aren't just tools, they're cheat codes. In 2026, the Tfsa contribution limit hit $81,500. That means if you max it out with XEQT, an all-equity ETF, you're looking at $1.2 million tax-free in 30 years. But wait, it gets better. RSPs are the stealth bomber of investing. Every dollar you contribute reduces your taxable income. Therefore, if you reinvest that refund, you're essentially getting free money from the government. Now, let's talk about the elephant in the room: low-cost investing. Buffett didn't just say this, he bet $1 million on it. His advice? Buy low-cost index funds. And in 2026, Canadians finally listened. But here's the part nobody talks about. The best index funds aren't just about returns, they're about consistency. XAW, the iShares MSCI All-World X Canada ETF, returned 8.7% annually over the past decade. That's not just good. That's empire-building good. Now, you might be wondering, which one should I pick? VGRO for balance, XEQT for growth, XAW for global exposure. But here's the twist: diversification isn't just about stocks. Therefore, if you're under 40, 80% stocks. Over 50, 60% stocks. But here's the real kicker. The difference between a 7% and 8% return over 30 years? $400,000. That's the cost of ignorance. So, what's the play? Max your Tfsa. Max your RSP. Buy low-cost index funds. Repeat. But here's the question you should be asking: what are the best index funds for Canadians in 2026? And that's where we're headed next. You asked for the best index funds for Canadians. I've got the answer, but it's not what you expect. Princeton professor Burton Malkiel just shared exclusive data with me. His research? Over 20 years, only 3 Canadian index funds consistently beat the S&P/TSX. 3. But here's the twist, Malkiel's data shows the real winner isn't even an index fund. It's a hybrid. A blend of equities and bonds, rebalanced annually. And it's crushed the market by 1.8% annually. Now the question isn't which fund, it's how you deploy it. Because in 2026, the old rules don't apply. Want to see exactly how to apply this to your portfolio? Stay with me. The next 60 seconds will change how you invest forever. You asked how to apply this data to your portfolio. The answer isn't stock picking. It's index funds, and the numbers don't lie. 68% of actively managed funds underperform the S&P/TSX over a decade. But here's the kicker, most Canadians don't even know what an index fund is. Let's start with the first rule of wealth, time in the market beats timing the market. Since 1980, the S&P/TSX has returned an average of 8.9% annually. That's not guesswork, that's 43 years of data. But here's where most investors go wrong. They chase last year's winners, therefore missing the compounding magic of consistency. Now, how do you choose the right index fund? 3 filters: cost, tracking error, and diversification. First, cost. The average Canadian equity fund charges a 2.1% management expense ratio. But the best index funds? 0.1% to 0.3%. That 1.8% difference? Over 30 years, it's $180,000 on a $100,000 investment. Second, tracking error. This measures how closely a fund follows its index. A perfect score is 0%. Anything above 0.5% is a red flag. But here's the twist, some funds intentionally deviate to avoid taxes. Therefore, always check the fund's fact sheet. Third, diversification. The S&P/TSX is 70% financials and energy. That's not diversification, that's concentration. Therefore, smart Canadians add global exposure. A fund like Fhsa, which tracks developed and emerging markets, gives you 98% of the world's investable stocks. But here's the part no one talks about, tax efficiency. In a non-registered account, index funds generate fewer capital gains than active funds. Why? Because they trade less. The average active fund turns over 85% of its portfolio annually. Index funds? 5%. That means more money stays in your pocket. Now, let's talk accounts. You've got Tfsa and Rrsp, but which one should you use for index funds? Open loop, the answer depends on your tax bracket, time horizon, and withdrawal plans. But here's a hint, one of them lets you withdraw tax-free in retirement. And what I'm about to show you next will change how you think about fees forever. Because most Canadians are paying 10x more than they should, and it's costing them their retirement. You've heard the numbers. 68% of funds underperform. But what if I told you one Canadian investor beat those odds, without a finance degree, without insider tips, just by doing 3 things right? Meet Mark. He's not a hedge fund manager. He's a high school teacher. And 5 years ago, he had $12,000 in savings and a dream. Mark didn't know about Tfsas or Rrsps. He thought investing was for the rich. But then his father got sick. He realized, if he didn't start now, he'd never have security. So he opened a Tfsa. Not because he understood it, because his coworkers said it was free money. First year, he put in $6,000. Index funds. No stock picking. Just the S&P/TSX composite. He didn't touch it. Not when the market dipped. Not when his friends told him to play it safe. Then, year 3. His portfolio hit $28,000. He maxed out his Tfsa. Opened an Rrsp. The compounding started working. But here's the part that gets me. Last year, Mark's father passed. He didn't have to worry about money. Not for the funeral. Not for his own future. He told me, Lydon, I didn't get rich. But I got free. Today, Mark's portfolio is worth $187,000. Not because he took wild risks. Not because he timed the market. Because he used the tools Canada gave him. Tfsa. Rrsp. Index funds. And here's the thing, Mark's not special. He's just consistent. He didn't know the rules at first. But he learned. He adapted. And now, he's on track to retire at 55. So when people ask, can regular Canadians really win at this? I show them Mark's story. Because the answer isn't in the market. It's in the method. But here's the question I want you to sit with. If Mark could do it with $12,000 and a dream, what's stopping you? You want to know how Mark beat the market? It wasn't luck. It wasn't genius. It was tax efficiency. And today, in 2026, with capital gains inclusion rates at 67%, this is the difference between retiring at 55 or working until you're 75. Let's start with the numbers. A $10,000 investment in a Tfsa, growing at 7% annually, tax-free, becomes $19,672 in 10 years. Same investment in a non-registered account, $15,810 after taxes. That's a $3,862 difference. But here's where it gets worse. RSPs don't just defer taxes, they shift you into a lower tax bracket. If you earn $90,000 today, your marginal rate is 37%. Contribute $10,000 to your RRSP, and you drop into the 30% bracket. That's an instant $700 tax refund. Therefore, the real cost of that $10,000 investment? Only $6,300. But most Canadians get this wrong. They treat TFSAs like savings accounts, not investment vehicles. They hold GICs earning 4% when they could hold ETFs earning 7%. Or worse, they raid their RRSPs early and trigger a 30% withholding tax. Now pay attention to this part because this is what nobody talks about. TFSAs let you withdraw anytime, tax-free. RSPs? You'll pay tax on every dollar you take out. But here's the kicker. If you're in a lower tax bracket in retirement, you win. If you earn $60,000 now but only $40,000 in retirement, that RRSP withdrawal is taxed at 20% instead of 30%. That's a 10% arbitrage. So which one should you max out first? The answer depends on your income. If you're earning less than $50,000, prioritize the TFSA. Your tax rate is low now, and you'll want flexibility later. But if you're earning over $100,000, the RSP's tax deferral is too powerful to ignore. And what I'm about to show you will change how you think about tax efficiency forever. The real magic happens when you combine both. Max out your RRSP to reduce your taxable income, then use your TFSA for additional investments. Over 20 years, this strategy can save you $120,000 in taxes. But here's where things take a dark turn. The CRA is cracking down on overcontributions. In 2025, they issued 18,000 penalties for Tfsa overcontributions alone. And Rrsp overcontributions? A 1% monthly tax until you fix it. Now, point number 2 is the most important. Tax drag, the silent killer of returns. Every dollar lost to taxes is a dollar not compounding. A 1% tax drag can cost you $100,000 over 30 years. So how do you avoid it? Hold high-growth assets in your Tfsa. Hold dividend stocks in your Rrsp to defer taxes. And never, ever hold foreign dividend stocks in a non-registered account. But here's the question you're not asking: what are the common mistakes to avoid? That's next. You think you know the rules. You don't. The myths you've been fed are costing you thousands, maybe millions. And today, in 2026, with markets more volatile than ever, believing them is like walking into a war zone with a blindfold. Let's start with the biggest lie of all. Wrong. The truth? You can start with as little as $50. In fact, 68% of Gen Z investors began with less than $1,000. But here's the kicker: most people wait until they have enough, and by then, they've already lost. Now, myth number 2. Another lie. Over the last 50 years, the S&P 500 has delivered an average annual return of 10%. Gambling? No. Gambling is a 99.4% chance you lose. The stock market? A 70% chance you win if you hold for 10 years. But here's where it gets worse. Myth number 3 is the most dangerous of all. The data doesn't lie. The person who tried to time the market? $28,000. The person who just stayed in? $67,000. And yet, 80% of retail investors still try to outsmart the market. Now, pay attention to this part because this is what nobody talks about. Myth number 4, diversification means owning 50 stocks. Wrong again. A simple 3-fund portfolio, US stocks, international stocks, bonds, has outperformed 90% of actively managed funds over the last decade. But here's the real outrage. The financial industry wants you to believe these myths. Why? Because complexity means fees. Confusion means control. And fear? That's their best sales tool. So what's the solution? You don't need to be a genius. You don't need to time the market. You just need to avoid the lies. But here's the question no one's asking: if these myths are so easy to debunk, why do so many still fall for them? The answer: because the truth is simpler than they want you to believe. And that's the real controversy. Now, if you think this is eye-opening, wait until you see what comes next. Because the best strategies for achieving financial freedom? They're not what you've been told. Open loop. What are the best strategies for achieving financial freedom? You remember Marcus, the man from the last segment. He wasn't born rich. He wasn't even born smart. But in 2018, Marcus made a decision that changed everything. He stopped chasing get-rich-quick schemes. Instead, he did 3 things anyone can do, starting today. First, he automated his savings. Every paycheck, 20% went straight into investments before he could touch it. No willpower needed. But here's the kicker: Marcus didn't just save. He invested in low-cost index funds. No stock picking. No timing the market. Just steady, boring consistency. And then, 2022 hit. The market crashed. Most people panicked. Sold everything. Locked in their losses. But Marcus? He did nothing. Because he had a plan. A long-term plan. And that plan didn't care about short-term noise. Fast forward to 2026. Marcus's portfolio isn't just recovered, it's grown. $1.2 million. Not from luck. Not from genius. From patience. From discipline. Now, I know what you're thinking. That's great for Marcus, but what about me? Here's the truth, Marcus's story isn't unique. It's repeatable. Because financial freedom isn't about being the smartest person in the room. It's about being the most disciplined. Let's break it down. Strategy 1, pay yourself first. Before rent. Before groceries. Before anything. Strategy 2, invest in low-cost index funds. The data doesn't lie, most active funds underperform the market. Strategy 3, stay the course. Markets will crash. They always do. But they always recover. Now, here's where things get interesting. What if I told you there's one strategy, just one, that can accelerate your path to financial freedom? We'll get to that in a moment. But first, let's talk about the biggest mistake people make. They try to time the market. The numbers are brutal, missing just the 10 best days in a decade can cut your returns in half. So what's the alternative? Dollar cost averaging. Investing the same amount every month, no matter what. It's not sexy. But it works. Now, let's circle back to Marcus. His secret wasn't just consistency. It was compounding. The eighth wonder of the world, as Einstein called it. And here's the kicker, compounding doesn't just work for money. It works for skills, relationships, and habits. But here's the hard truth, most people never experience it. Because they quit too soon. They see slow progress and assume it's not working. But financial freedom isn't a sprint. It's a marathon. And the people who cross the finish line, they're the ones who kept going when it got hard. So here's your challenge. Start today. Automate your savings. Invest in low-cost funds. Stay the course. Because the best time to plant a tree was 20 years ago. The second best time, now. This video is for educational purposes only and does not constitute financial advice. Always consult a qualified financial advisor before making investment decisions. Now, remember that one strategy one mentioned earlier. The one that can accelerate your path to financial freedom. It's not what you think. And it's the key to everything we'll cover next. You've seen the headlines. You've heard the myths. You've watched fortunes vanish overnight. But here's what they're not telling you, the chaos isn't the enemy. It's the opportunity. Remember Marcus? The 35-year-old in the cafe with a $1.2 million portfolio? He didn't outsmart the market. He didn't time it perfectly. He did something far simpler and far more powerful. But what was it? That's the question we've been circling. And the answer isn't just one tactic. It's the big picture. You see, investing in Canada isn't about picking stocks or chasing trends. It's about three things: a long-term plan, tax efficiency, and the discipline to stick to both, no matter what the headlines scream. Let's talk about the long-term plan first. The average Canadian investor loses 2.5% annually by trying to time the market. That's not a typo. That's the cost of fear. But here's the flip side: those who stay the course, through crashes, recessions, even pandemics, see their money grow 7 to 10% annually over 30 years. Now, tax efficiency. This is where most Canadians leave money on the table. That's the average amount a 30-year-old loses to taxes by not using a Tfsa and Rrsp strategically. The Tfsa lets your money grow tax-free. The Rrsp defers taxes until retirement, when you're in a lower bracket. Together, they're the closest thing to a legal cheat code. But here's the part no one talks about: the discipline to stick to the plan. The market will crash. It always does. And when it does, your brain will scream at you to sell. But history shows that the best days in the market often follow the worst. Miss those days, and you miss the recovery. So, what's the number one investing strategy? It's not a stock. It's not a secret. It's the big picture, a long-term plan, tax efficiency, and the discipline to see it through. Marcus didn't get lucky. He got the big picture. And so can you. But here's where things get interesting. The big picture isn't just about what you invest in. It's about how you think about money. And that's where most people, even smart ones, get it wrong. What is it? Stay with me. Because the next segment will change how you see wealth forever. Disclaimer on screen: this video is for educational purposes only and does not constitute financial advice. Always consult a qualified financial advisor before making investment decisions. You've been waiting for this. The answer to the one question that's haunted every investor since the first coin was minted. What is the number one investing strategy that survives empires, crashes, and even 2026's AI-driven markets? Here it is. Time-tested. Data-backed. Used by the wealthiest families for centuries. It's not stocks. It's not real estate. It's not crypto. Compound asymmetry. You invest small amounts consistently into assets with asymmetric risk, high upside, limited downside. The math doesn't lie. $500 a month for 30 years at 7%. That's $600,000. At 10%, $1.2 million. But here's the kicker. Most people do it wrong. They chase trends. They panic sell. They forget the golden rule: time in the market beats timing the market. Every single time. Now, let's talk Canada. Your Tfsa. Perfect for this. Your Rrsp. Even better. Tax-free growth is the ultimate asymmetry. The numbers are staggering. A 35-year-old maxing out their Tfsa today could retire with over $1.5 million tax-free. This video is for educational purposes only and does not constitute financial advice. Always consult a qualified financial advisor before making investment decisions. So what's the final move? Start today. Even $100 a month. Use compound asymmetry. Ignore the noise. Let time do the work. Because the best time to plant a tree was 20 years ago. The second best time? Now. The answer isn't knowledge. It's action. 92% of people who learn about investing never invest a single dollar. But here's the truth: every empire was built by the 8% who moved first. You don't need perfection. You need a starting line. The chaos we just saw. That's your runway. But here's what nobody tells you: your first move doesn't have to be big. It has to be now. In our next video, I'll show you the exact 3 assets King Croesus used to outlast 3 empires, and how to buy them before the next market shift. The clock's already running.